You have to have a view on the equilibrium to have a view on the 10-year. Now, this is where many people switch off. They'll say, well, I can't observe this R star or this equilibrium rate, so I'm not going to use it. Well, everyone who buys or sells a 10-year security is implicitly taking a view on that number, because the 10-year yield is not defined by today's policy rate. It's defined by the path of that policy rate and where it ends up in the longer run. So if you think that the longer run equilibrium policy rate is 4, for example, then you think that the yield probably won't go down much more from here. And you would also think that the Fed isn't particularly restrictive.
Okay,
right? That's an interesting point.
So
Yeah.
Is the Fed restrictive? Because I can't figure out. And then also, when you answer that question for me, what goes into making that determination whether or not they are restrictive?
Yeah, so our assumption is that the Fed's longer run equilibrium is about where the Fed thinks it is, which is 2.5%, and it's sort of 2.7 to be precise, and it's pretty much unchanged from before the pandemic. Now, I would look at this as scientifically as possible. It's difficult to be a scientist in bonds, really, but the point is, what has changed? And it's very easy to say the market indicates something has changed, therefore the world has changed. That's not good enough. All there is a risk premium around the possibility that the world has changed. It's very different. So I think that the policy is restrictive because today's rate is more than double what the longer run equilibrium is.
How do you look at something like fiscal stimulus? And I appreciate that you're going to say that that's cyclical. But when we're looking at something globally from the energy transition, where companies, private equity, and governments are going to be spending boatloads of money in the next 30 years, how does that fit into your model? Yeah,
so there's a debt and a deficit. There's a stock and a flow effect. I think that when you're talking about deficits that are going up and therefore more bonds, you can see how that can feed into the risk premium. But then the debt stock is a drag on longer run growth because it has to be rolled over and financed, and it takes cash flow away from investment and consumption. My point is that it can be a little bit too easy and somewhat lazy to say there's a lot of supply, therefore the yield has to go up, because you really do need to know what's on the other side. Now, when it comes to bonds, the substitution effect, if you like, it depends on the value. What do bonds look like compared to stocks? What do bonds look like compared to money? What do government bonds look like compared to credit, et cetera, et cetera? It strikes me that the valuation argument for bonds is looking pretty good.
All right, so what am I supposed to buy right now?
Well, most real money investors, and that's different to a hedge fund or a trader, are sitting in what we call the belly, in the middle maturities, in credit. That way they mitigate the negative carry because the market's implying the cuts. So, good quality, you can buy indices of good quality credit, and you're going to get a yield more than on the S&P 500 forward earnings. And to me, you could have said that at any point in the last year, but ultimately it's a safe investment to be buying good quality US corporates.
What about in the Treasury curve? Where do you think we're going to see the most action?
Alex, you mentioned the steepener. That's been playing out. Do you know that the movement in, let's look at 2s 10s, right? The 2s 10s has moved about as much as it did in the 1 month after the 2016 election, which says that if there is a trade around this, it just played out. It just happened. Now, it's all about the probabilities around the election result, and we've just seen a huge swing in that in the last few weeks. So the idea that it was all one-way traffic and there was only going to be one winner and one outcome with one set of policies, that's no longer clear today. So if the steepener was predicated on that, then I think people will start to think again. So it's, to put a steepener on at this point today, given how much it just moved, I think would be dangerous.
But what if it wasn't about the election? What if it was about pricing in the cuts?
And I think you're spot on, because in fact, it's been the recent inflation prints and the cooling real economy that has dominated the scenario analysis and the fiscal views and the election views. And so that's explained the steepening. That's explained why 2s are pushing to the low yield for the last year. But the problem is, if you enter today, you buy a 2-year that is so far through the money market rate that if the Fed isn't cutting, and cutting by more than is priced in on the WIRP screen, you're not going to make any money.